There is a very specific type of person who has become filthy wealthy over the last 5 years. They don't work at Goldman Sachs. They don't run a hedge fund. They don't manage a single dollar of institutional capital. In fact, most of them have never passed a licensing exam, never sat through a compliance review, and couldn't explain a discounted cash flow model if their rent depended on it. But they will absolutely sell you a course on how to build generational wealth for 3 easy payments of $297. I'm talking about financial influencers. And before you say, I already know this is a scam, just hang on. Because what I want to show you today isn't just that some of these people are frauds. That part's obvious. What I want to show you is the actual mechanism, the incentive structure that makes this industry not just dishonest, but mathematically designed to keep you financially stuck. Because this isn't just a few bad actors with ring lights. This is a $1.3 billion content economy with its own supply chain, its own feedback loops, and its own version of gambler's ruin baked right into the business model. And by the end of this video, you're going to look at every finance video you've ever watched, including maybe this one, a little differently. Let's start with the numbers, because the numbers are where it gets uncomfortable. There are currently over 10 million pieces of financial content posted online every single month. YouTube, TikTok, Instagram, X. It doesn't matter. The platforms are drowning in videos about trading strategies, passive income blueprints, dividend portfolios, and real estate hacks. And the people making this content, most of them are not making money from the strategies they're teaching. They are making money from you watching them teach those strategies. Here's the breakdown. A mid-tier financial influencer with around 500,000 subscribers earns somewhere between $8,000 and $25,000 per month in ad revenue alone. Add a course, a paid community, an affiliate link to a broker, and a coaching program, and that number jumps to anywhere between $50,000 and $150, 0 per month. That's not a portfolio return. That's a media business. And the product isn't financial advice. The product is you. And that would be fine, genuinely fine, if the content was accurate. But here's where the incentive structure starts to rot from the inside. Because on the internet, accuracy doesn't pay. Engagement pays. And engagement is driven by one thing: emotion. Specifically, the two emotions that have driven every financial decision since the first human traded a goat for some grain. Fear and greed. Think about what actually gets clicks. The stock market is about to collapse. This one ETF made me $40, 0 last month. The trade the banks don't want you to know about. These titles perform because they trigger a visceral reaction. You click not because you're calm and analytical, but because something in your brain said, "Wait, what?" And the algorithm doesn't care if the video is accurate. The algorithm cares if you watched it for more than 30 seconds. So you end up in a system where the content that spreads fastest is the content that is most emotionally manipulative. And the creators who grow fastest are the ones who have figured out how to make you feel like you're one video away from financial freedom. They're not lying, exactly. They're just optimizing for the wrong thing. Now let me introduce you to someone. Meet Tyler. Tyler is 26. Tyler found financial YouTube during the pandemic, watched about 400 hours of content in 4 months, and decided he had figured it out. He opened a brokerage account, bought a handful of growth stocks, a few dividend ETFs, and started a Roth IRA. Not bad so far, actually pretty reasonable. But then Tyler found the influencer corner of finance. And the influencer corner told Tyler that dividend investing was for boomers, that index funds were leaving returns on the table, and that if he just learned options flow, he could quit his job in 18 months. So Tyler bought a $499 options course. He joined a Discord server for $49 a month. He downloaded a charting platform that cost him $89 a month. He started paper trading, then real trading, then revenge trading when his first 3 positions went wrong. 12 months later, Tyler's brokerage account is down 31%. He spent roughly $2,200 on subscriptions and courses. He's logged more screen time analyzing charts than he spent in his last 2 years of college. And the influencer who sold him the course just posted a video about his new Porsche. Tyler isn't a bad investor. Tyler is a normal outcome in a broken system. And here's the mechanism that makes it broken. It's called the aspirational proof problem. The only people who go viral showing their returns are the people with extraordinary returns, which means the sample of financial influencers you see online is not a random sample of investors. It is the most survivorship-biased group of people on the internet. You see the 1 in 10,000 trader who turned $5,000 into $200,000. You do not see the 9,999 people who followed the same strategy and lost money. Those people don't post. They just disappear quietly while the winner sells a masterclass. And the worst part is the winner usually believes it too. Because here's the thing about getting lucky in a bull market, it feels exactly like being good. The dopamine is the same. The confidence is the same. The Porsche is the same. The only thing that's different is what happens when the market stops going up. And this is where the math becomes genuinely predatory. When a financial influencer builds their entire brand on a strategy that only works in rising markets, they are selling you something that has an expiration date they aren't disclosing. Leveraged ETFs, high beta momentum plays, meme stock accumulation. These strategies can produce mind-bending returns when the market is in a euphoric phase. They can also produce the kind of losses that make grown adults cry in their cars. And the influencer who made the course in 2021 has no obligation to update you when the environment changes. They already have your $497. There's a real number that illustrates this problem. Studies on retail investor performance consistently show that the average retail investor underperforms the S&P 500 by roughly 3 to 4 percentage points per year. Not because retail investors are stupid, but because they trade too much, buy high, sell low, chase trends, and follow advice from people whose incentive is content performance, not portfolio performance. Over a 30-year investment horizon, that 3 to 4 point drag compounds into a difference of hundreds of thousands of dollars in retirement savings. That's not a rounding error. That's a beach house that doesn't exist because someone watched too many trading videos at 11 p.m. So what does this actually mean for you? Here's the framework, because this shouldn't end in nihilism. First, follow the money backwards. When someone is teaching you how to get rich, ask how they're getting rich. If the answer is the strategy they're teaching, great. If the answer is you watching them teach the strategy, that is a conflict of interest that should make you deeply skeptical of everything they're saying. Second, survivorship bias is invisible by design. You have to actively go looking for the failure rate. Before buying any course or following any strategy, search for people who tried it and failed. They exist. They just don't show up in your algorithm because failure doesn't monetize. Third, credentials aren't everything, but they're something. A licensed financial advisor has a legal fiduciary obligation to act in your interest. A person with 800,000 TikTok followers does not. That asymmetry matters, especially when real money is involved. Fourth, simplicity outperforms complexity in the long run more often than not. A boring 3-fund portfolio, contributed to consistently over 20 years, beats the average active retail trader, not because it's exciting, because time and compounding don't care about your content calendar. Fifth, if the pitch involves urgency, it's probably a bad deal. This opportunity closes Friday. I can only take 12 more students. The market window is closing. These are sales tactics designed to bypass your rational brain. Real financial opportunities don't expire at midnight. Here's the gut punch that I want to leave you with. The financial influencer economy is not inherently evil. There are genuinely smart, honest people making educational finance content. But the system they operate inside of rewards the wrong behaviors. It rewards entertainment over accuracy, confidence over nuance, and virality over track record. And when that system touches something as consequential as how people manage their money, the collateral damage is real. It shows up in retirement accounts that are 30% smaller than they should be. It shows up in people who spent their mid-20s learning options theory instead of just buying index funds. And it shows up in the comment sections of every trading video, where someone always asks, "Is it too late to start?" And the algorithm serves them 6 more videos answering yes, but only if they act right now. So here's where I want to hear from you. Do you think financial influencers are net positive? Entertainment and education that democratizes access to information, even if some of it is bad? Do you think they're net negative? A content machine that profits from retail investor confusion and hands billions of dollars in fees to platforms and course sellers? Or is the real answer that the incentive structure is broken and the people in it can't fix it, even if they want to? Drop your take in the comments because the answer actually matters, and I want to see how split everyone is on this one.